Hey everyone, big news today. The recession, well, it already started. Yeah, it has. The S&P 500, it's in an earnings recession for the first time in 3 years, and it's expected to get worse. Mark my words. Here's what's happening, what you need to do to both stay safe and get way ahead of the crowd. Stay tuned. First of all, I predicted this would happen. It's precisely why I've been going on and on and on about protecting your assets. Watch this important update, then click the button below to find out the best way to not only survive in the market decline, but to thrive in it. Let's get into it right now. All right, so let's talk about this recession that we're in. You're probably thinking to yourself, what in the world is Roger talking about? The S&P 500 set a 52-week high. We're literally making new highs every day. Well, it looks that way on the surface, but let's talk about reality here, all right? Earnings. They just ended. Second quarter earnings are down 35 cents a share. First quarter earnings are down 29 cents a share. That's the first back-to-back decline that we've had since the second quarter of 2016. Now, technically, two back-to-back declines in earnings equal a recession. And let me tell you another thing. Next quarter, the expectations are not down 0.29% or 0.35%. Next quarter, the expectations are down almost 4%. That's more than 10 times the decline that we saw this quarter. Now, 4%, nothing crazy. We're not talking about 20%, 15%, but the trend is getting weaker. Moreover, if you look at the GDP was below the 2% target that we've set over the last few years. It was actually at 1.7%. So is America in a real major recession? No, but technically speaking, when you have earnings drop 2 quarters in a row, that's technically a earnings recession. Now, do I believe this is going to continue? Here's what I believe. I'm going to share with you my theory, and I've shared this theory with my bootcamp students. That's my private membership area. But let me tell you about this. I believe, first of all, I'm not gauging the US stock market by the S&P 500. I'm gauging the stock market by the Russell 2000 right now. Why? If you look at the S&P 500, you'll find that it's being driven by literally a handful of stocks. You see, US indices are capitalized weighted. What does that mean? That means the bigger the stock, the more market cap it has. All right? The more say it has, the more power it has, the more it can control the index. So you can literally have Apple, Amazon, Microsoft, and a few other large cap stocks drive the entire stock market. If I'm talking about the S&P 500. So the S&P is not really a fair assessment of how the overall market's doing. I would look at the Russell 2000, and the ticker symbol for that is IWM, as in Mary, IWM. And the Russell 2000, if you notice, it's been in a completely sideways trading action for the last 9 months, almost a year. I think it's about 10 months now. So that's reflecting the economy. Now, here's another thing that I believe. I believe if the Fed did not lower rates 3 times this year, including when the market was at a 52-week high, not a 52-week low, 52-week high, I believe it would have pushed the Russell not to move sideways like it's been moving over the last several months, but I believe it would move lower. And I believe that would push the overall S&P 500 lower. That's like putting a 50-pound iron weight on a runner. You get tired really, really quickly. So in my opinion, we are in a recession, but because the Fed, in my opinion, again, because of the pressure that President Trump has put on them, they'll deny it till the day they die, but we know better. All those tweets, I think they've been resonating with the Fed. So I believe the Fed has been listening to President Trump, and they've been lowering rates in anticipation. And I think that gave a stock market recession a soft landing and caused most of the indices to go sideways and the S&P to actually rally. But I believe over the next several months, as US and China resolve these differences, the small caps will start moving back up. They haven't made an all-time high. Last time they did that was, I believe, November or October of last year, because small caps are much more sensitive to the overall stock market than the S&P 500. The companies are smaller. They don't have as much diversification to shield them from China, the trade war we're having with China. So again, I believe possibly we could be in the worst case scenario over the next quarter or two, and then we'll see some sun at the end of the rainbow, so to speak. We'll see some sunshine. All right, but we're not there yet, and we really have to focus on earnings, because if this pattern continues, and it looks like it's going to continue for a few more quarters, we may get into some more congestion or possibly downside on the stock market. And that's why you got to be really quick and you got to be really nimble right now with your trading tactics and be defensive. It's time to be very defensive and stay out of stocks that are vulnerable to China. Folks, remember, there's no need to panic in this situation if you have the right strategy, and that's a big if. Click below to find out what I'm doing right now. It's not only about protecting, it's about profiting in this market environment. And that's totally possible with the game plan that I'm going to share with you right now. You'll even find out what trades I'm making in the market this minute. Folks, this recession will get worse. And if you wait any longer to take action, don't be surprised if you get hit by major losses. Take control starting now.